When it happens, it's going to be a stampede out of the dollar and a rush to get into gold, which is why people should be buying the dips now. Don't worry about it. If people who don't understand where we're headed are doing the wrong thing, you just keep on doing the right thing. The other thing that traders overlook, of course, is what rising interest rates are going to do to the stock market, what they're going to do to the economy. If you think we have a strong economy, well, if interest rates rise, there goes that economy, because the economy is a bubble and rising rates will prick it. You have all this borrowed money and it's all more expensive if interest rates go up. Same thing with the real estate market. Same thing with the stock market. Asset prices are very much a function of interest rates. And in fact, I said this on the podcast, the stock market is far more vulnerable to a decline based on rising interest rates than is the gold market, especially the NASDAQ, these growth stocks. They are highly sensitive to interest rates, far more so than the value stocks that pay good dividends now that compete with those higher interest rates. And here is the rationale. In case you don't understand this, growth stocks are stocks that are not producing income now, right? Investors are looking into the future and they think that they're going to grow into their earnings, right? These are going to be, they're spending a lot of money now, they're growing their businesses, they're going to have all this growth, and eventually they're going to have all these earnings, and then they're going to be able to start paying dividends in the future. I don't get any dividends now, I'm just waiting to get the dividends in the future that are going to be the result of all the growth. Now, when interest rates are zero, does it cost you any money to wait 10 years for your income? No, because there's no opportunity cost. There's zero interest. So if you have really, really low rates or zero, you can put a very high multiple on a growth stock that isn't going to deliver earnings until many, many years into the future. On the other hand, let's say you have high interest rates. Say interest rates are 10%, right? Well, if I'm waiting for a stock to grow into earnings and I have to wait 10 years, well, it costs me 10% a year while I'm waiting. So if I'm going to have to give up all that income to wait for this growth stock to potentially start, paying dividends, well, I'm not going to be willing to pay nearly as high a price as the price I would have to pay if I wasn't giving up any income.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
Now, of course, rates don't have to be 10%, whatever they are. If they go to 1%, 2%, 3%, any increase in the interest that I can get on my money today, that produces a reduction in the value of whatever income a growth stock could potentially produce in the future. So the stock market is much more vulnerable, particularly the high-flying NASDAQ. And so what is going to happen if rising interest rates cause the stock market to crash? Well, we already know what's going to happen. We saw what happened last year in March when the stock market crashed because of COVID. What did the Fed do? The Fed quickly brought interest rates back down to zero and unleashed QE infinity. Now, if the air starts coming out of that bubble again, if the stock market, which is even more overvalued now than it was pre-COVID, and the economy is even more screwed up now than it was then, the deficits are much bigger now than we were then, and we don't have Donald Trump as president who's promising lower taxes and less regulation. We have Joe Biden as president who's promising higher taxes and more regulation. The market could tank even more now than it did then. So what is the Fed going to do? Just sit on its hands and do nothing? Of course not. The Fed is going to come up with a much bigger increase in its quantitative easing program. That is what's coming. Now, I don't know, the markets, for some reason, they're just waiting to hear it, right? They can't figure it out. They can't read between the lines, even though the lines are pretty wide and easy to read between. They're just waiting for the Fed to actually come out and say what should be obvious, or not just say it, do it. They're waiting for this program. But when it happens, it's going to be a stampede out of the dollar and a rush to get into gold, which is why people should be buying the dips now. Don't worry about it. If people who don't understand where we're headed are doing the wrong thing, you just keep on doing the right thing.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.